A silent alarm just went off in the global financial system. It wasn't triggered by stocks, employment data, or corporate earnings. It came from gold, an asset that almost never moves violently without reason. Over the last year, it has surged 50%. And every time in modern history that gold has climbed this far, this fast, the economy wasn't entering a crisis. It was already drifting towards one. The difference now is unsettling. The crisis isn't visible, not in markets, not in growth figures, not in the headlines. But gold is behaving as if the foundation beneath all of it is beginning to shift. For months, equity markets have been unfazed by geopolitical conflict, rising debt servicing costs, or weakening household balance sheets. Indexes broke new records. Analysts upgraded forecasts. The narrative settled into something familiar: a resilient economy, a strong consumer, and the promise of a soft landing. But another metric, the one that captures how people actually feel, showed the opposite. Consumer sentiment fell into some of the lowest levels in the last half century. Not during a recession, not after a market crash, but during one of the strongest stock rallies in years. It was the kind of divergence that rarely appears, and when it does, it signals pressure building beneath the surface. Gold has been mapping that divergence in real time. The relationship is historically tight. As sentiment falls, gold rises. The precious metal doesn't respond to optimism or pessimism in isolation. It responds to the distance between how the system looks and how the public experiences it. And that distance is now wider than at any point in the last 5 decades. While markets signal strength, households feel strain. The economy on paper is booming. The economy on the ground is tightening. And gold is the conduit between those two realities. This pattern isn't new. In the mid-1970s, a 50% surge in gold preceded a deep recession and the unraveling of the post-Bretton Woods monetary system. In 1980, it signaled the peak of an inflationary spiral that forced interest rates towards 20%. In 2008, gold rose 50%, just months before the global financial system buckled under the weight of hidden leverage. In each case, gold accelerated before the cracks became visible. It wasn't forecasting fear, it was responding to imbalance. Today's imbalance begins with government debt, a chart stretching back to the 1960s that shows a steady incline for decades, until 2008. The global financial crisis shattered the old trajectory. Debt shot upward. A decade later, the pandemic sent it vertical. The United States now carries a debt load rivaling the scale of World War II, but without the wartime mobilization or post-war production boom that once made such levels manageable. And in 2020, a quiet but historic shift occurred. Federal debt exceeded GDP. For the first time in generations, the economy no longer produced enough value to plausibly outrun obligations tied to it. When debt climbs beyond what an economy can reasonably service, the options narrow. Default is politically impossible. That leaves inflation, erosion by design. The burden doesn't show up as a headline crisis, it shows up as higher prices, stagnant wages, smaller savings, and households slowly losing ground even during periods of economic expansion. This is why sentiment collapses while markets surge. People are not reacting to financial headlines. They are reacting to shrinking purchasing power. They are experiencing a silent crisis long before market reflects it. Gold has no ideology. It doesn't respond to headlines, elections, or public optimism. It responds to math, imbalances between debt and output, between currency supply and real value, between trust and instability. The gap between headline prosperity and lived reality is widening, and gold is tracing that gap. But domestic pressure is only half the story. A global shift is unfolding at the same time. For decades, U.S. Treasuries were the backbone of international reserves. They were treated as unquestionable stores of safety. That assumption is now fading. China has been selling treasuries steadily and replacing them with gold. After being cut from the global banking system, Russia accelerated its move into physical reserves. India, with a rising global footprint, is building gold reserves at a pace it never pursued before. In just 2 years, central banks purchased more than 2,000 tons of gold, the highest levels since modern tracking began. These institutions are not reacting to short-term price swings. They are repositioning ahead of a long-term structural change, a world where the US dollar may no longer dominate global reserves as effortlessly as it once did. Gold cannot be frozen. It cannot be inflated. It cannot be sanctioned. In an era defined by geopolitical tension, those characteristics matter more than they have in decades. A transition away from dollar supremacy will not happen overnight. Financial systems rarely fracture suddenly. They shift slowly, quietly, through thousands of smaller decisions made long before the world acknowledges them. But gold moves early. Its rise is often the first visible reflection of declining confidence in the stability of a currency system built on debt that can no longer be contained by conventional tools. Look back at the 1970s, when the dollar's link to gold was severed. What followed was a decade of instability, runaway inflation, collapsing sentiment, and a surge in gold from $35 to more than $800 an ounce. The Federal Reserve eventually broke the cycle by raising interest rates high enough to force a recession. But the conditions that made that intervention possible no longer exist. Debt today is far too large. The system is far too leveraged. And a 20% interest rate would not stabilize the economy, it would break it. This is why gold is rising now, not due to panic or speculation. It is reacting to a mathematical reality. The tools that once restored trust in the currency can no longer be used. The system is shifting, not collapsing, and the movement is global. Imagine a ship whose exterior appears pristine. Strong winds, clear waters, confident passengers. But beneath the waterline, stress fractures widen. Not enough to sink it immediately, but enough that the structure is weakening faster than the crew can repair it. Gold is the indicator that tracks those fractures. Its rise is the pressure gauge. A 50% surge is not noise. It's the same signal that appeared before every major economic inflection point of the last 50 years. The difference this time is scale. The sentiment gap is larger. Debt is larger. Global distrust is larger. And gold is responding not just to domestic instability, but to a gradual realignment of how nations store value and hedge risk. The stock market may continue to rise. Liquidity and narratives can sustain optimism far longer than fundamentals can. But gold is charting something deeper: the erosion of confidence in the currency that underpins the entire system. This is not a forecast of sudden collapse. It is the outline of a silent transition, a long grinding shift in the architecture of global finance. A move away from the assumptions that define the last 50 years. A world where nations prepare for uncertainty, not with treasuries, but with something older, simpler, and outside the reach of policy decisions. The pattern has already emerged. The water has already appeared. The largest economies in the world are quietly repositioning while the surface narrative remains calm. Gold is not predicting catastrophe. It is documenting the early stages of a structural transformation. And transformations rarely announce themselves until they are too large to ignore.